Are you aiming to achieve financial success? Then, you will have to start investing, but that too very intelligently. You may get rich overnight by investing your money. In this video, we will be guiding you about the 10 best investments that will make you rich. Don't skip the video from between, as all the investments are important for you to know and for better choice also. Now let's start. 1. Series I Savings Bonds. The Series I Savings Bond is an inflation-protected, low-risk investment. The bond's interest rate is increased higher whenever inflation does the same. Bond payments, however, decrease as inflation rates decline. The U.S. Department of the Treasury's website, treasurydirect.gov, is where you may purchase a Series I bond. The I bond is a good choice for protection against inflation because you get a fixed rate and an inflation rate added to that every 6 months. The interest rate on a Series I bond is linked to the rate of inflation and resets every 6 months. The bond yields much more than the rate of inflation. 2. Short-term certificates of deposit. In an FDIC-insured bank CD account, your principal is safe until you withdraw the money before the CD matures. You should do some comparison banking online to locate the best rates. A 2022 investor may find it prudent to hold on to short-term CDs and reinvest the money earned as rates continue to increase. You should try to stay out of CDs that pay interest rates that are too low for too long. An alternative to a CD with a short maturity period is a CD with no early withdrawal penalty. This allows you to get your money out of the CD and into a better yielding CD without incurring any fees. The CD's interest rate is guaranteed by the bank for as long as the CD remains uncashed. The interest rate on a high-yield savings account may be greater than the interest rate on a CD, but the initial deposit may be rather expensive. Click on the red subscribe button below and also the like button if you want to know more investing options. 3. Money market funds. Brokerage businesses and mutual fund companies often provide money market funds, which are pools of certificates of deposit, CDs, short-term bonds, and other low-risk assets pooled together to diversify risk. In contrast to certificates of deposit, CDs, money market funds normally do not impose early withdrawal fees. Minnesota financial planner Ben Wasek thinks that money market funds are generally secure investments. The bank guarantees a certain interest rate, and it aims to ensure that each share never drops in value below $1, he explains. 4. Treasury bills, notes, bonds and tips. In addition to Treasury bonds, Treasury notes, and Treasury inflation-protected securities, TIPS, the U.S. Treasury also issues the following. In little more than a year, Treasury bills become due. Treasury notes have maturities of up to 10 years. Government bonds may be held for up to 30 years. Treasury inflation-protected securities, TIPS, are bonds whose face value moves in the opposite direction of inflation. All of these investments are easily traded and held, making them ideal for trading often. Unless you acquire a negative-yielding bond, you can't really lose money by holding onto treasuries until they mature. 5. Corporate bonds. Bonds are issued by businesses as well, and they may range from quite safe, issued by huge, prosperous enterprises, to extremely dangerous. High-yield bonds, sometimes known as junk bonds, are the absolute worst kind of bond available. High-yield corporate bonds may be discovered, but they tend to have a low interest rate and poor quality, according to Cheryl Kruger, the founder of Growing Fortunes Financial Partners in Schaumburg, Illinois. There's not only the interest rate risk, but also the default risk, therefore in my opinion they are riskier. When interest rates vary, so does the market value of bonds. Bond prices increase when interest rates decrease and fall when interest rates rise. 6. High-yield savings accounts. The return on savings accounts is low since they are not considered investments. Online research will lead you to the selections with the best yields, and if you're prepared to compare rates and shop about, you may earn even more interest. Your money in a high-yield savings account is risk-free and will never disappear. Your money is safe in most accounts since the government insures them up to $250,000 per account type per bank. Although inflation might reduce the purchase power of cash, it retains its original worth. 7. Dividend-paying stocks. Stocks are riskier than cash, savings accounts, or government debt, but safer than options and futures. Equities that pay dividends are often seen to be more stable than high-growth equities because the cash distributions they provide serve to dampen volatility. Thus, dividend stocks will experience market volatility but may not see as large of a decline during market downturns. Investors tend to see dividend-paying stocks as safer options. To paraphrase what Wasek has to say, I wouldn't say a dividend-paying stock is a low-risk investment because there were dividend-paying stocks that lost 20% or 30% in 2008. In comparison to growth stocks, however, it carries less of a risk. Investors like dividend-paying stocks because they provide a steady income stream in addition to the potential for capital gain. 8. Preferred stocks. When compared to ordinary equities, preferred ones are more akin to junk bonds. However, if the market crashes or interest rates increase, there might be a significant shift in their value. Preferred stock, like bonds, pays interest and dividends at set intervals. Companies that issue preferred stock have the rare option of temporarily suspending dividend payments, albeit they often have to make up any missing payments. And dividends on preferred shares must be paid before dividends on ordinary stock may be paid. In comparison to common stock, preferred shares are safer but still carry some degree of risk. 9. Money market accounts. A money market account has many of the same features as a savings account, such as the ability to make withdrawals and earn interest. In contrast to a savings account, a money market account often requires a larger opening deposit. Money market accounts may pay interest at a greater rate than traditional savings accounts of similar size. Additionally, you will have the freedom to spend the money as you see fit. However, the money market account, like a savings account, may restrict the amount you may withdraw each month. 10. Fixed annuities. An annuity is a financial contract, often with an insurance company, that guarantees payments of a certain amount, at regular intervals, for a set length of time. There are a variety of methods in which the annuity may be set up to pay out to the customer from a set length of time, say, 20 years, through the client's last day. A fixed annuity is a kind of annuity in which the contract guarantees payments of a certain amount at regular intervals, often monthly. You may either make a single, large payment and start receiving payments right away, or you can make smaller, regular payments into the annuity and have it start making payments to you at a later period, such as when you retire. That's all for today. Now you know all the 10 best and low-risk investments that will make you rich very easily. You must invest in these assets to become a millionaire in this year. These investments are preferred by Sir Warren Buffett, Jeff Bezos, Mark Zuckerberg, Bill Gates, and many other multimillionaires. Press the subscribe button below if you really want to become financially knowledgeable and successful. Click on the like button to motivate us. Leave a comment below if you got any queries regarding the video. Share this video with everyone you know. Thanks for watching.